You know that moment when you finally pull the trigger on a purchase and the price collapses right after? You buy a phone and the next day it's discounted by $200. Now scale that feeling up, way up. Imagine it happening to your entire investment portfolio. You bought Bitcoin near the top, around $104,000 in November 2024. You weren't gambling, you did the homework. Institutions were finally stepping in. BlackRock launched the ETF. MicroStrategy was stacking billions. The narrative looked airtight. And now you're staring at price action that keeps chopping between roughly $85,000 and $98,000. So the question keeps looping in your head. We hit all-time highs, ETFs are live, institutional adoption is real. Why isn't Bitcoin trading at $150,000 or $200,000 already? What's missing? My name is Michael, and I spend an unhealthy amount of time thinking about why markets refuse to behave the way they're supposed to. If you bought Bitcoin anywhere between roughly $95,000 and $118,000 over the past few months, believe in the technology, understand the scarcity thesis, but can't reconcile that with the price action you're seeing, this video is for you. I wasn't planning to make this. The whole banks are suppressing Bitcoin idea always sounded like late-night Twitter paranoia, the kind of claim people throw around without evidence. But once I started digging into how modern financial institutions actually operate, legally operate, I ran into something I couldn't ignore. What I found wasn't secret meetings or illegal collusion. It was documented, lawful financial structures, the same kinds of mechanisms that have wiped out multi-billion-dollar companies in the past. The same tools that have been used historically to bring entire economies under control through debt. And here's the uncomfortable part. That exact playbook may be in use right now against the largest Bitcoin holders on the planet. If you own Bitcoin, you need to understand this. So let me start with a story that sounds unrelated, but it isn't. In 1982, Mexico made what looked like a smart move. The country borrowed billions from international banks to fund infrastructure, stimulate growth, and invest in its future. The problem wasn't the borrowing itself. The problem was the currency. That debt wasn't denominated in Mexican pesos. It was denominated in US dollars. That detail changes everything. Mexico couldn't print dollars. It could only earn them through exports or borrow even more. So when the U.S. Federal Reserve raised interest rates aggressively to fight inflation, Mexico's debt burden exploded overnight. The dollar strengthened, the peso weakened, and suddenly Mexico owed around $80 billion with no realistic way to repay it. That's when the IMF stepped in with what was branded as a rescue package. But that rescue came with conditions. Mexico had to agree to something called structural adjustment. Mexico's rescue came with strings attached. They were forced to privatize state-owned companies, social spending was slashed, markets were open to foreign capital. In plain terms, Mexico had to sell pieces of itself just to stay solvent. And this wasn't a one-off. The same sequence played out in Argentina, Brazil, Indonesia, dozens of countries over the next few decades. Different locations, same outcome. Now you might be thinking, Michael, what does this have to do with Bitcoin? Everything. What I just described is a debt spiral, and what makes a debt spiral so destructive isn't just the math, it's the psychology. When your obligations are denominated in a currency you don't control, you're not just exposed to market risk, you're exposed to loss of control, loss of leverage, loss of sovereignty over your own assets. Here's the key point most people miss. This mechanism doesn't only apply to nations, it applies to companies too. And right now, there is a company holding more than $60 billion worth of Bitcoin, structured in a way that makes it potentially vulnerable to this exact trap. Let me bring this closer to home. Imagine you own a house worth $500,000. You take out a $100,000 home equity line of credit at a variable interest rate. At first, rates are low. Your payment is maybe $400 a month. Comfortable, manageable. Then, the Federal Reserve raises rates. That payment jumps to $900, then $1,100. Your income hasn't changed, but your obligations have. At that point, you really only have three options. You sell the house, you refinance, which usually means taking on even more debt, or you default, and the bank takes the asset. This is where the psychological trap kicks in. The moment you start worrying about making payments, your decision-making deteriorates. You might sell the house below value just to avoid default. You might accept awful refinancing terms just to buy time. And all the while, the lender knows you're cornered. No crime has been committed, no laws were broken, but the structure guarantees that when conditions change, rates rise, markets tighten, your interests and the bank's interests diverge sharply. That's what I call financial pressure without financial crime. Now scale this up. Instead of a house, imagine $60 billion worth of Bitcoin. Instead of a HELOC, imagine $16 billion in convertible bonds and preferred shares. And instead of a homeowner, imagine a publicly traded company whose stock price directly determines whether it can hold its Bitcoin or is forced to liquidate it. That company exists. It's MicroStrategy. And if you want to understand why Bitcoin may be experiencing artificial downward pressure right now, you have to understand how MicroStrategy is structured. So, let's start with what MicroStrategy actually is. On paper, it's a software company. Technically, they still sell business intelligence software. In reality, that's no longer the core of the company. What they've turned into is a leveraged Bitcoin vehicle wrapped inside a public corporation. And the structure they're using is both extremely clever and extremely fragile. Here's how it works. They raise capital in three main ways. First, by issuing common stock. Second, by issuing convertible bonds. Third, by issuing preferred shares. Every dollar raised through those channels flows in one direction, into Bitcoin. Right now, they hold roughly 450,000 Bitcoin. At current prices, that's about $45 billion in value. Their total purchase cost is closer to $27 billion, which means they're sitting on an unrealized gain of around $18 billion. On the surface, that sounds like a home run, but the structure matters. Those convertible bonds come with interest payments. The preferred shares come with dividend payments. And this is critical. Preferred dividends are not optional, unlike common stock dividends. They can't just pause them. Miss those payments and you're in default. All in, the company owes roughly $700 million per year just to service debt in preferred dividends. That's close to $2 million every single day. So where does that money come from? Not from the software business. That side of the company generates roughly $100 million in free cash flow annually. It helps, but it doesn't come close to covering the obligation. To bridge the gap, they've accumulated a cash reserve of about $1.2 billion explicitly to keep those payments going. At the current burn rate, that cash lasts about 20 months, less than 2 years. And this is where the debt spiral risk becomes very real. Their stock trades at what's called a premium to net asset value. In simple terms, if you take the value of all their Bitcoin and subtract their debt, you might get a figure around $30 billion. But the market is valuing the company closer to $50 billion. That extra $20 billion is the premium. Why does that premium exist? Because investors believe the company can keep buying more Bitcoin, and Bitcoin will keep appreciating. As long as that premium exists, the flywheel works. They issue new shares, use the proceeds to buy more Bitcoin. Bitcoin rises, the stock rises, they issue more shares. Rinse and repeat. It's self-reinforcing. But the entire system depends on one thing staying true. The stock must trade at a premium. If the market decides it's no longer willing to pay $50 billion for a company whose net assets are worth $30 billion, the premium disappears. And once the stock trades at a discount, issuing new equity stops making sense. Selling shares at that point would be equivalent to selling Bitcoin below market value. So, equity issuance shuts down. At that moment, the $1.2 billion cash reserve becomes the only buffer between the company and forced asset sales. Roughly 20 months, that's the runway. And if they're forced to sell Bitcoin to meet debt and dividend obligations, the consequences cascade. Selling pressure pushes Bitcoin lower. A lower Bitcoin price drags the stock down. A weaker stock removes any chance of raising capital, which forces more Bitcoin sales. That's the spiral. Not because of fraud, not because of incompetence, because of structure. This is the death spiral. Now, the obvious question is, why would anyone want this to happen? Why would large banks or institutions want to push a company like MicroStrategy into that kind of corner? They issue new shares, use the proceeds to buy more Bitcoin. Bitcoin rises, the stock rises, they issue more shares. Rinse and repeat. It's self-reinforcing. But the entire system depends on one thing staying true. The stock must trade at a premium. If the market decides it's no longer willing to pay $50 billion for a company whose net assets are worth $30 billion, the premium disappears. And once the stock trades at a discount, issuing new equity stops making sense. Selling shares at that point would be equivalent to selling Bitcoin below market value. So, equity issuance shuts down. At that moment, the $1.2 billion cash reserve becomes the only buffer between the company and forced asset sales. Roughly 20 months, that's the runway. And if they're forced to sell Bitcoin to meet debt and dividend obligations, the consequences cascade. Selling pressure pushes Bitcoin lower. A lower Bitcoin price drags the stock down. A weaker stock removes any chance of raising capital, which forces more Bitcoin sales. That's the spiral. Not because of fraud, not because of incompetence, because of structure. This is the death spiral. Now, the obvious question is, why would anyone want this to happen? Why would large banks or institutions want to push a company like MicroStrategy into that kind of corner? This is where the psychology turns uncomfortable, but also very familiar if you've studied financial history. Picture a major investment bank. Their clients want Bitcoin exposure, not retail traders, real money, pension funds, endowments, sovereign wealth funds. These institutions operate under strict mandates. They can't just open a Coinbase account and buy Bitcoin outright. Volatility rules, custody rules, regulatory risk, it's all a problem. But what if there were a way to acquire Bitcoin below market price? What if instead of paying $95,000 per coin, they could effectively buy Bitcoin at $70,000 or $75,000? That's where distress comes in. If MicroStrategy is forced to sell Bitcoin, they won't dump it on an exchange. They'll do block sales. That means calling a handful of large banks and saying, "We need to move $5 billion worth of Bitcoin. Who's interested?" Those banks don't buy at spot. They demand a discount, 10%, 15%, sometimes 20%, because they're absorbing size and risk. Suddenly, billions of dollars of Bitcoin changes hands below market value. The bank can then place that Bitcoin with clients at a markup or keep it on its own balance sheet. Either way, they win. But for that scenario to exist, MicroStrategy must be under pressure. The stock has to trade below net asset value. The cash reserve has to shrink. The margin for error has to disappear. So how do you accelerate that pressure? You short the stock. Let me be very clear before people misinterpret this. I'm not claiming there's a secret cabal coordinating attacks. I don't have emails or phone calls or proof of collusion. What I do have is precedent. In the early 2000s, Wall Street used a financing structure called pipe deals, private investment in public equity. One version, known as a floorless convertible, became notorious. Here's how those worked. A struggling public company needed cash. A hedge fund would step in and offer a loan, but instead of being repaid in cash, the fund would be repaid in shares. And here's the catch. The lower the stock price fell, the more shares the lender received. Pause on that. If you're the lender, what incentive do you have? Higher stock price or lower? The financial incentive was to drive the price down, and the methods were predictable: aggressive shorting, negative narratives, fear amplification. Regulators noticed. The U.S. Securities and Exchange Commission investigated hundreds of these deals. The results were brutal. Companies that entered these arrangements saw their stock prices fall an average of 34% within a year.
Roughly 85% posted negative returns, and nearly half were delisted entirely, effectively destroyed.
This wasn't theory. It wasn't a fringe idea. It happened to real companies, real investors, real employees. And it was legal. Now, to be precise, MicroStrategy does not have floorless convertibles, but the pressure mechanics, the incentives, the leverage points, the psychological traps are eerily similar. The debt structure may be different, but the psychology is identical. If you're a hedge fund or a bank and you believe a company will eventually be forced to liquidate a core asset, the strategy is obvious. You short the equity, apply pressure, and wait. This isn't hypothetical. In February 2025, MicroStrategy traded at a valuation roughly $10 billion below the value of the Bitcoin it held. Let that sink in. Buying the stock at that point meant you were effectively getting Bitcoin at an 18% discount compared to buying Bitcoin directly. Markets don't do that without a reason. What the market was saying was simple. Yes, you hold a massive amount of Bitcoin, but you're also carrying about $16 billion in debt. If conditions turn against you, forced selling becomes a real risk, and when that happens, everyone downstream gets hurt. At the same time, short interest in the stock exploded. Billions of dollars in bearish positions were built. We don't know every participant, but some names were public. Jim Chanos, one of the most well-known short sellers in history, openly stated he was betting against the company. On top of that, JP Morgan released multiple research notes arguing that the company was overvalued, that its structure carried significant risk, and that a deep enough stock decline could result in removal from major indexes. If that happened, index funds would be forced to sell, adding even more downward pressure. Was any of that illegal? No. Publishing research is protected. Short selling is a standard market activity, but legality doesn't change the outcome. The combined effect is sustained pressure on a company that is structurally sensitive to pressure. This is how modern financial warfare actually works. You don't need fraud, you don't need collusion, you just need to understand incentives and press where the structure is weakest. It's like poker. You don't cheat, you read the table, and when someone is boxed in, you raise. Now put yourself in the position of Michael Saylor. Your stock is being heavily shorted, you have fixed obligations, your options are all bad. You can keep buying Bitcoin and hope price momentum saves you. You can issue more shares, which dilutes shareholders and feeds the short narrative. Or you can reduce debt, which means selling Bitcoin, the very asset your entire strategy is built around. You're trapped, and the traders betting against you understand that. They're not rooting for chaos, they're betting on a specific outcome, that pressure eventually forces Bitcoin sales at the worst possible moment. Those sales validate the bearish thesis and generate profits for the shorts. This is the uncomfortable truth. This has nothing to do with Bitcoin's technology failing. It has nothing to do with the scarcity model being wrong. It's about financial structures being used to extract assets at a discount from the largest holders. Now let's address the question that should be forming in your mind. If this is even partially true, what does that mean for you? Should you be worried? Should you sell your Bitcoin? No, and here's why. The people who understand this dynamic aren't the ones who panic, they're the ones who position themselves correctly. First, separate the asset from the company. Bitcoin is not MicroStrategy. Bitcoin is a decentralized network with no balance sheet and no debt. MicroStrategy is a publicly traded company with a layered capital structure, fixed obligations, and financing risk. If MicroStrategy ever runs into trouble, that does not mean Bitcoin failed. It means a company made specific leverage decisions that carried consequences.
That distinction matters. Second, understand what pressure actually signals. If large banks and institutions are trying to engineer situations where Bitcoin can be acquired through distressed selling, that tells you something important. It tells you they want the asset. They believe in its long-term value. They're just unwilling to pay full price. So if you're a long-term holder, Panic selling during periods of manufactured stress is the worst possible response. That's the transfer mechanism. Retail sells at $85,000, institutions accumulate. Later, the same asset gets distributed back to clients at much higher prices. Third, pay attention to timelines. MicroStrategy's situation isn't infinite. Based on current numbers, there's roughly a 20-month window tied to cash reserves and obligations. Markets hate visible countdowns. As that clock runs down, volatility increases. But if Bitcoin recovers before that window closes, if refinancing becomes viable, or if new capital is raised on better terms, the entire death spiral narrative collapses. Now let's make this practical. Say you bought Bitcoin at $100,000 in November 2024. You invested $10,000, so you own 0.1 BTC. Today, Bitcoin is trading around $92,000. You're down $800. It feels bad. You're thinking about selling. If you sell now, that loss is locked in. But assume this pressure thesis is correct. Assume forced selling pushes Bitcoin down to $78,000. You panic later and sell there instead. Now your loss is $2,200. Compare that to a different response. You understand what's happening, you recognize accumulation pressure. When price drops to $78,000, you add another $7,800. You now hold 0.2 BTC. Your total investment is $17,800. 6 months later, pressure resolves. Refinancing happens. Shorts unwind. Bitcoin trades at $140,000. Your 0.2 BTC is now worth $28,000. That's a gain of $10,200, not because you had inside information, but because you didn't emotionally capitulate when pressure peaked. This is the real edge in markets. Winners don't have perfect information, they have emotional discipline. This is where professional investors differ from retail. When price drops, retail thinks, "I'm losing money." Professionals ask, "Why is this happening? And has the underlying thesis changed?" They don't react to candles, they study mechanisms. If they conclude price is being distorted by leverage, structure, or financial engineering, not by a breakdown in fundamentals, they do the opposite of what panic demands. They accumulate. That's how wealth transfers actually occur, not through scams, not through fraud, through psychological pressure applied at scale. And Bitcoin is uniquely vulnerable to this dynamic because volatility is already part of its nature. Pressure hides easily inside noise. When Bitcoin drops 20%, retail investors feel fear immediately. They look at the chart, see red, and their brain jumps straight to loss avoidance. Institutions don't react that way. They zoom out, they pull on-chain data, they analyze wallet flows, long-term holder behavior, exchange balances, issuance schedules, and adoption metrics. And very often, they reach a completely different conclusion. Price moved, but nothing structurally changed. To them, volatility is not information in itself. It's a signal that needs context. A sharp drop doesn't automatically mean something is broken. It often means leverage was flushed, weak hands exited, or pressure was applied through derivatives and financing structures. That distinction matters because one is noise and the other is a thesis failure. We've seen this exact dynamic before, long before Bitcoin. In the 1990s, central banks around the world began selling off their gold reserves. The most famous case was the Bank of England, which sold roughly half of Britain's gold at an average price near $275 per ounce. The decision was approved by Gordon Brown, who was Chancellor of the Exchequer at the time. The market later nicknamed that moment the Brown Bottom. The official justification sounded rational. Gold didn't produce yield. It was considered outdated. Holding dollars or bonds was framed as more efficient. On paper, it made sense, but markets don't care about justifications. They care about outcomes.
Over the next 2 decades, gold rose from roughly $275 to over $1,900 per ounce. The opportunity cost of those sales ran into the billions. Whether those decisions were naive or strategic is still debated. Some argue central banks misread the future. Others believe private institutions were more than happy to absorb supply at suppressed prices. I can't prove coordination. I'm not claiming secret meetings or backroom deals. What I can point to is a recurring pattern that shows up again and again across markets. Large, visible sellers create sustained pressure. Prices decline. Long-term capital accumulates quietly, and eventually, prices recover, often dramatically, while the original sellers are left explaining why they exited at the worst possible moment. Now ask yourself an uncomfortable question. Does Bitcoin fit the profile of an asset institutions would want exposure to, but at lower prices? Scarcity, portability, global settlement, no counterparty risk, growing institutional infrastructure, ETFs, custody solutions, regulatory clarity improving over time. The incentive structure is there. That doesn't mean Bitcoin is guaranteed to go up tomorrow. It means that if price is being pressured through leverage, structure, or forced selling rather than a collapse in fundamentals, then volatility becomes a transfer mechanism, not a verdict. So let's move away from theory and talk about behavior. What should you actually do with this information? First, stop letting short-term price movement dictate long-term decisions. Bitcoin is volatile by design. Asking whether it can drop 20 or 30% misses the point. The better question is whether the underlying thesis, scarcity, decentralization, and demand in a fiat expanding world has materially changed. If it hasn't, then price swings are stress tests, not signals to surrender. Second, watch MicroStrategy the right way. Not headlines, not Twitter clips, actual filings. Cash position, debt maturity timelines, refinancing terms. If you ever see sustained forced selling of Bitcoin driven by balance sheet stress, that's meaningful. Until then, most of what you're seeing is pressure applied through perception and positioning. Third, diversify with intention, not fear. Concentration amplifies emotion. Diversification isn't about avoiding losses, it's about preventing a single narrative from controlling your behavior. Bitcoin can be a core position without being the only position. Fourth, and this is where most retail investors permanently fall behind, learn how market mechanics actually work. Debt spirals, convertible bonds, preferred equity, net asset value, index inclusion and exclusion, short interest dynamics. These aren't abstract concepts, they are tools that move billions of dollars. Investors who understand these structures don't panic when price drops. They ask why the drop happened and who benefits from it. Everything I've walked through, historical debt traps, financial engineering in past decades, and MicroStrategy's current structure, connects to one core reality. Financial engineering is neutral. It doesn't care about narratives. It doesn't care about beliefs. It only responds to incentives. Most people don't realize a wealth transfer is happening until after it's over. They just see their portfolio falling and conclude they were wrong. Often, they weren't wrong about the asset. They were wrong about the game being played around it. I'm not here to give you price targets. I'm not promising timelines. Anyone doing that is guessing. What I am doing is showing you how pressure can be applied to an asset through entirely legal means, and why understanding that pressure makes you harder to exploit. Because investing isn't about being right in the short term, it's about understanding risk, managing emotion, and allowing time to work with you instead of against you. So what happens next with Bitcoin? I don't know, but I do know this. Institutions don't spend time, capital, and complexity attacking assets they believe are worthless. Worthless assets are ignored. They attract no strategy, no leverage, no effort. Pressure is applied to assets that are valuable but inconveniently priced. So if you're feeling uneasy right now, ask yourself one honest question. Do you still believe in the long-term thesis? Do you believe a scarce, decentralized digital asset has a place in a world where currency supply expands relentlessly? If the answer is yes, then volatility doesn't invalidate your strategy, it tests your discipline. And if the answer is no, then Bitcoin was never the right asset for you, because this volatility, this pressure, this drama isn't going away. This is the environment.
If this video helped you see what's happening beneath the surface, subscribe. Drop a comment and tell me whether you think this pressure dynamic is real or overstated. And most importantly, keep learning, because the strongest defense against financial manipulation isn't prediction, it's understanding. I'll see you in the next video.